Hello, hello, good morning, ladies and gentlemen. Welcome to day 2 of Switch 2025. Thank you so much for joining us bright and early. It's so lovely to see all of you. Now, every single day we have a different theme at the Converge stage, and today it's all about startups. So we closed out an incredible first day and we dug into, the challenges and opportunities facing major industries. So, as I said, the day 2 theme is all about the founders, the risk takers, and the visionaries who are translating deep technology into market-ready solutions. So whether you are hunting for your next investment, or you're looking for a disruptive partner, or dreaming of launching your own venture, you are at the right place. This stage is perfect for you. So we're going to start off our opening session, which is a must-attend for every single entrepreneur. It's titled Funding Winter or Selective Optimism, Navigating the AI Investment Landscape in 2025. So this session is designed to give founders a candid, clear-eye view of the current market. It's powered by NUS and Microsoft, and our experts today will dive into what works and what doesn't in pitches, and the strategic steps founders must now take to attract capital in 2025 and also effectively prepare for the upcoming year in 2026. So without further ado, let's welcome our moderator for this panel, David Isaac, founder of AI Path. Joining David on stage, we have Hian Goh, founding partner of Open Space Capital. We also have Murli Ravi, co-founder and managing partner of Tin Man Capital. Somgan Chowdhury, co-founder of AI Palette. And I'm going to pass the time over to David. Take it away.
All right, everybody, thank you for being with us bright and early on day 2. My name is David Isaac. I'm founder at AI Path. So the question today is Singapore drowning in capital? Can startups get all the money they need? Or are VCs being very selective today? So there are outliers. We're seeing some people raising hundreds of millions of dollars within 9 months of inception in California. What is it like in Asia and Southeast Asia? Today we've assembled successful founders and successful VCs. So if anybody is in the broader audience, if you're raising money or you'd like to, if you're an LP who is looking to get confidence into a VC fund, please join our panel. So we have a few preset questions for today, but before I begin, I'd like to give each of our panelists a chance to introduce themselves, and we're going to say what they say to the startups. What is your 1 or 2 line introduction? Please.
Hi, I'm Som, the co-founder of AI Palette. At AI Palette, we help the FMCG companies with their new product innovation using the power of AI. We started in 2018 and 2019. I was here at Slingshot, and now we got acquired early this year, so it's nice to be back again.
All right, and Murli, please, your introduction.
Thank you. My name is Murli. I'm one of the co-founders of Tin Man Capital. Hian just reminded me that we are very old, and he said we've been investing for, I don't know, almost 20 years now, something like this, or been entrepreneurs and investors. At my firm now, what we invest in is enterprise technology primarily, and we prefer enterprise technology for old sectors, traditional sectors. In fact, Som is one of our former investees since before he got acquired. So we like essentially tech for industries like manufacturing, logistics, consumer, essentially all these old industries that are being remade by technology.
My name is Hian. I'm the founding partner of Open Space Ventures. Open Space Capital. So we just expanded our capabilities. We're 800 AUM tech private equity firm. We have venture growth, private credit, and now pre-IPO. Firm was started 12 years ago in 2013, really out of a reaction that there wasn't enough innovation capital in ASEAN. And I had firsthand knowledge of that because I was an entrepreneur. Prior to that, I started a TV network called Asian Food Channel. I ran that for 10 years. So been doing this, and then I was an investment banker financing semiconductor companies since the beginning of the 2000s. So I've been dedicated to the ASEAN mandate for 26 years, and real pleasure to be on the panel. Thank you very much, David, for having us.
It's my pleasure, Enterprise Singapore and NUS's pleasure. Thank you all for those introductions. So we'll start off with a question. Does everything have to be AI? Does it matter if you're not AI, do you still matter? So one quick statistic for you all to respond to. AI's share of VC investments was as high as 58% in Q1. And I'll preface that as the initial stat for us all to respond to. We have interesting companies like Lovable, which a lot of people forget is a turnaround and a rebranding, which is now a rocket ship, but you know, in their first iteration, they were not a rocket ship, but now they're at 100 million ARR in just 8 months. Obviously, that is not the everyday story, right? So let's talk about the medians today. And we'll start with our VCs, and of course, we'll get to Som shortly. What are you thinking in terms of B2B over B2C? And additionally, what do you think now in terms of AI versus non-AI?
I thought you said Som. Is it me?
We'll get to Som. So this is the VC question. What are you looking at? What's relevant? What has immediately become irrelevant?
Yeah, so we have to step back and let's take a 40-year viewpoint about life, right? So 40 years ago, we went from mainframe. So we went from centralized to decentralized to PC. And then 30 years ago, we went from PC to mobile. So in other words, the internet invented the ability to get information. Mobile invented the ability to get information anywhere. And then AI has now created, you know, the ability to get intelligence and through the various platforms anywhere at any time. And I bring that up because every 10 years, there is a significant shift in technology. So 10 years ago, when that happened, I started a venture capital fund, and then we invested into Gojek and Chope and Redmart, and e-commerce became just commerce. So we are going through right now, in the past, I would say 36 months, a transitory phase in the business models globally. And I just bring that up because during that period of time, everyone needs to reset. So the entrepreneurs go, well, maybe I should be doing something new, and the venture capitalists too. So I just want to bring out the fact that it's not that we don't have capital. I think it's just that everyone's trying to figure out the new trajectory. And I'm just going to stop there because I think that's the first point.
And before we pass on to Murli, one quick answer here. Deal quality or quantity at this early stage of disruption with AI?
So deal quantity has gone down significantly, and that's fabulous because I don't need 6,000 emails. We get regularly about 3,000. You probably get around there. The firm actually reviews deeply 500. I personally meet 250 teams a year, 5 teams every week, roughly, on a partnership level. So I don't need a high signal to noise ratio. I actually do enjoy the current situation, which is that only the really crazy and dedicated human beings are choosing to attempt to be a startup. And this was not the case in 2001 when it was very fashionable to do so. So I like that.
Okay, so let's get to Murli. What are your thoughts on?
Yeah, so I think your question originally was AI versus non-AI, right? I think the view that we take as a firm is technology will keep changing, right? Ian was very correct to point out the various evolutions of technology. So I don't like to necessarily focus on tech for tech's sake. I like to focus on what problem are you solving, how valuable is that problem, how large is that problem, those kinds of things, rather than sort of how you do it, right? The how is important, don't get me wrong, but the more important is what are you doing it and why are you doing it, and why will you succeed, right? So we're talking about AI right now, and guess what? When we started the firm, which is a younger firm than Ian's firm, it was all about AI then. It was just a different kind of AI. 20 years ago, I was writing, actually a bit longer than that, I was writing AI code myself. Different kind of AI, right? So I was doing neural networks at the time, but not to the scale that neural networks operated 10 years ago versus even today, right? So that cycle continues, it will keep changing. Neural networks actually existed, I don't know, from the 60s, something like that, right? So more than even 40 years ago. So it's not about the technology. What we care about is, okay, you're actually going after this particular space. What's your domain knowledge there, right? Do you understand the workflows in that industry? Do you understand how to actually sell to those people? Do you understand how to retain, right? Those kinds of things matter much more to us. In terms of B2B versus B2C, as I said, we are purely enterprise focused. So even within enterprise, we tend not to do SME focused companies, right? So even though that's B2B, so I don't really have a strong view on B2B versus B2C as in a professional capacity. Personally, obviously, I'm using a whole bunch of things for fun, right? But that's not our investment focus.
And that's very interesting. The VCs that I'm talking to in California, they are now not talking about what is your MRR and ARR. They're talking about what is your retained MRR and your retained ARR, because they're very concerned with fads, trying things and dropping them and trying some other things as well. But now we'll pass over to Som, and then what are your thoughts around this? Do you think that it's important to be AI native, or is traditional SaaS okay? And I'm sure a lot of people are sending you their pitch decks to get you on their board of advisors or strategy. What do you think?
Is there any company which is not an AI company today? Everybody seems to have a .ai domain. But jokes apart, I think when we started in 2018, we thought about AI even though it was not as mainstream as it is today, because we realized that it's one of those fundamental technologies which is going to be core as we go more about it. And we wanted to solve a global problem using it. And that's when I thought about whether we should go B2C or B2B. We realized that building a B2C company from here in Singapore, in Southeast Asia, is going to be difficult, because there is always going to be a competition somewhere in the valley who will have a lot more funding and a lot more outreach. For B2C, you need a lot more money to burn when it comes to marketing and reaching out to the consumer. On the other hand, for B2B, you don't need as much marketing. So we went B2B where it is much easier to prove the ROI, where you work with the large corporates, and as soon as you prove a value for them, either by saving money or saving time, you can scale with them. So the opportunity to grow the NRR was significant, and those are the matrices which we were able to show, and we were able to build a global B2B AI company from Singapore.
So I won't let you off yet. So VCs, please pay attention to this question. Is your advice that startups should raise early seed and build an MVP here and then continue fundraising and growing for Series A overseas? Or do you feel that they have different options available to them? And then the VCs, this is going to be a feisty question, because capital is everywhere, customers are everywhere. What's your advice?
So I think it really depends where you are and what kind of company you are building, right? So if you are based out of here and your customers are here, you have to raise the money over here, because the investors in the valley, they will have very different scale to measure the things. And the kind of growth that you can get in the valley. For example, you can reach 1 million ARR in about 6 months in the valley. To do it in Southeast Asia, it's going to take much longer. So even if you build a good business, the comparables, the measurables are completely different. So yeah, until and unless you are there in the valley, it would be very difficult for you to raise money there, because your customers are here, you might as well raise the money in this particular market.
So VC friends, obviously there's no silver bullet. How can we guide founders to make this decision?
Yeah, look, I even go one level, back from what your question is, right? Your question is whether to raise money here or in the valley. I'll even say very often that companies should not or do not need to raise venture capital at all, right? Don't come to us because our money is expensive, right? Come to us when it's actually appropriate for you. The best money that you can get to grow your company is customer money. Number one, get a customer to pay you money, right? Number two would be, other sources. Could be grants, so on and so forth. You benefited from some grants yourself. Those are actually much better than VC money. When you eventually choose to get VC money, obviously you got to choose whether to raise here, raise there, those kind of questions. But in addition, you actually want to decide what kind of partner do I want, and it's not just the firm. Like some firms, some companies choose to partner with VC firms simply because they would like the brand, and that's it. And it's a perfectly valid choice. Some others say, a bit like what Som was saying, look, I need someone with the domain expertise, or relevant relationships in that industry so they can bring, potential partners to me, potential, co-investors to me, et cetera, right? Some people might say, no, I need someone who's actually started a company before and can actually walk me through potentially the mistakes that I'm potentially, setting myself up for so that I can avoid those mistakes. So decide what you want, make sure you have the right questions to ask, not just answering other person's question. Don't just answer the investor's questions, but ask questions as well.
So we'll keep it lively for Hien. So we'll go off script a bit. With AI startups no longer able to get that 80% gross margin profitability that SaaS startups used to do, because AI tokens are much more expensive, do you feel that startups can still grow by revenue? Or do you think VC is an important part of this?
How much time do we have? Okay, I'm going to burn like 4 minutes. If I burn like 4 minutes, right? I think the first thing we want to talk about is how does one raise money? And as an entrepreneur, as a venture capitalist, having done this for like 20 over years, the way I think about it is that you really have to understand that trends come and go. And venture capitalists are given money based upon the trends. So right now in Silicon Valley, people have raised a lot of money saying that I'm going to find the next hot AI company. So if you're very, very focused on the AI opportunity, there's an argument that you go to Silicon Valley. And the problem is that everybody else is there. I don't know who has actually been to the Valley to attempt to raise money. I go there 3 times a year. I mean, to say that they have a short attention span or, completely distracted would be an understatement. And I don't blame them because their signal to noise ratio is very high, and then you're just like some random person from Southeast Asia who doesn't know Dave Morin who started up Instagram. So good luck to that, right? So I can't give you a generalized answer. If you're an Asian American startup, I mean, if you're a founding team with an Asian American person with a nexus, good luck. Which then begs the question, how does one raise money? So I think the answer is you should position your startup based upon the thing that's actually fashionable. And I mean, this is coming from a venture capitalist. Like, just be fashionable. So unfortunately today, if you walk into open space and you don't say that you have some AI, everyone's going to scratch their head, right? So I think that's the first thing you have to play. And then to your point about what kind of companies you create in Southeast Asia, I think a great category would be to the reinvention of existing things. Like, is there a reinvention of a travel app? Is there a reinvention of Chope? I just sold Chope, so we're going to try and reinvent it. And AI then becomes like agentic as opposed to foundational models. And then to add on to the complexity, I'm starting to see some serious hardcore foundational model teams raising money in excess of $100 million, and one of them hasn't even incorporated their company yet. I'm seeing the froth right here in Singapore. And you know where that's coming from? Primarily from Chinese founders hiding out here. And they're not going to go to They're not going to go to the US. So recently I saw a foundational model team from a country. I don't know whether they went to see you. Really great guys. Video model, hardcore, right? Really like has more research papers than everyone else. And he's hiding out here. So Singapore still has got a nexus, I think, globally for certain kinds of capital. We're in the business of trying to put money to work. But yeah, there's also the Valley and there's also other places. So it's a very hard question to answer. But I would say that there is selective optimism. The thing that you have to do as a founder is to make yourself look like the thing and go to the places where people are looking for that look and then plonk yourself down there. That's all the
I want to
advice
disagree
have.
with something you just said. Can I do that?
Yeah, let's go.
Yeah, so our firm, we have a sort of a phrase that we use. We like boring but important. So actually, if you're fashionable, good for you. But if you're not, that's fine. The latest company we invested in is something that's extremely boring.
No, so then, if you do have that, then you know Murali is your guy.
That's right.
Then you don't have to go to. Then the mistake would be you go to the Valley thinking you got a better chance. So you got to know your customer at the end of the day.
Exactly right. Know your customer. So when I said ask your potential investor questions, these are the kind of questions you want to ask, right? Look, what kind of stuff are you interested in? How do you deal with companies when things go wrong, or et cetera, right? So figure out who this person is, what they enjoy, and stuff like this. So when I said we like boring but important, our latest investment is a company which actually does software for banks in emerging markets. I mean, snooze fest, right? It's not just software, meaning like, okay,
That's very exciting.
No, it's exciting if you're doing, like, for example, card issuance, loans, and stuff like
AI
that.
girlfriend or
No,
that.
there's no really. I mean,
Okay,
there is some
we'll
AI. They're actually reinventing core banking, like super boring, like hardcore stuff,
Yeah.
right? Keeping records of bank accounts, right? Very difficult to do in real time. So therefore, it is valuable. But is it on the top of everyone's minds? No. Maybe
But
regulator cares
I'll
about it.
tell you this. 9 out of 10 venture capitalists in Singapore just kick you out just because you're not AI. That's my point. Like, at least go in and say we do AI for like boring stuff, and everyone
Well,
then
they're the
everyone
1 out
take
of
the
10.
meeting, and then you just tell them, okay, actually it's not that AI. At least you're in the door, right? That's the problem about fundraising, right? The signal noise ratio is very high, and I'm giving as practical advice as possible after 2 decades of PTSD.
Okay, so then in terms of signal or mirage, right? If a company like Lovable or Devin is, in the hundreds of millions of MRR, and the valuations are the 10, 15, 20 billion dollars within a year, for Southeast Asian startups who are talking to you about those as benchmarks, right? With implications on dilution and valuation, what are your responses? This is open to the panel.
You're saying when startups come in and pitch themselves as comps to those guys?
And so they come here and they say, look, I know that the median valuation in California has grown from $9 million last year to, I think it's about $27 million now, the median seed valuation. And they come to you. How do you sense check them? How do you discuss? How do you get on the same page?
I'll just I think the first thing, and if you go to my website under the open space capital thing, we're all supposed to be given a line. And my line is like the time it takes to be an overnight success is about 10 years. Right, for every lovable, and I've seen this so many times, so you just have to trust it. Every time you talk to a successful entrepreneur who's just made a big round, the guy's really, or the girl's really frustrated. It's like, you guys didn't see us over 10 years grinding it out, right? Like, not like getting any attention. So when somebody who is currently in the grinding out phase goes and says, oh yeah, but he raised a lot of money, how come you guys don't want to raise a lot of money? I usually ask that guy to go talk to the exited founder, and he, half the time, the founder who just raised a big round go like, please, seriously, like, it took a longer time than this. You're only seeing the headline. So you have this information availability bias. I think you put your head down and you try and make a product that works, and you try and figure it out fundamentally. I think that the good investors appreciate the sincerity, the tenacity, and the emotional authenticity of just trying to do something very hard. And the guys who are really blinded by, I want this big round, stuff like that, well, that's a different kind of investment that I don't do. So if you come and see me, I'm less of the, somebody raised a lot of money and that kind of stuff. I'm like, what are you making? Why are you making it? Why are you making it? Is it 10 times faster? Is it 10 times cheaper? How are you going to be better than everybody else? How far are you in it? And how much capital do you want? And let's come and figure out a fair price, because the last thing you want to do is to raise a super high valuation and get screwed on your next round.
And what about what are you going to do with that capital? Isn't that like a really foundational question?
Absolutely. Like, go onto my LinkedIn page. There's like 6 things. What are you building? Why are you building it? How much faster is better than it? Who's building it? Is there any traction? How much money you need, and what are you going to do with that money? You just literally have to go through that. And then at the end of it, just go like, so I need the money. Are you going to give me the money? It's okay if you don't, because most people don't. Most people don't want to invest before the S-curve. So what kind of guy are you? Because last I heard, you called yourself a venture capitalist. Like, you're allowed to say that to a venture capitalist, and then the venture capitalist says, no, I don't like you because you suck. I'm like, okay, great. Then you leave, right? You're allowed to say that.
Yeah, in our case, I think we have an approach which, I agree with everything you said. Our approach is somewhat different from most venture funds. You already heard why we're different in some ways. One other way we're different is that, every VC will tell you they are founder focused, founder aligned, and stuff like that, okay? And we do too. I'll tell you what that means for us, okay, which may not be the same for others. When I say we're founder aligned, in our portfolio, in my current fund, we have 7 or 8 companies, right? Super concentrated. If he sneezes, I catch cold. Like, it's that level of concentration. So what that means is that if a company does well, we're actually mind-blowingly happy. If a company is going through some rough patches, we're also extremely depressed. That's abstract. Let me put it in concrete terms. We like companies that are capital efficient. Okay, So if you're coming to us and saying, look, over my life of my company, I need to raise $100 million, $200 million, that's actually bad for us. And we think it's bad for the founder. And so here's where the alignment comes in. If a company can raise, an okay amount of capital, and we're early in the company, and you sell for, not raise, right? You sell for 100, 200, something like that, and the founder still owns 30 to 60% of the company, that's life-changing, right? And that's why we align. We're not actually looking to say, look, don't be a unicorn. If you are, great. More power to you. But you don't need to be. You don't need to shoot for something that's extremely low probability and actually flame out. If you end up selling for a decent number and you start again and you do it better, etc., it's more power to you, and we're very happy. We'll end up getting a 5x, 10x, 20x, and we're fine with that.
I just want the audience to know, you're not the usual VC.
Yes.
That's what I'm saying. Like, that was my point. But I really like the way you do things, but you're not the usual VC. Most of them are not like that.
And
which is why I explained why our definition of founder line is different from other VCs.
And so that's the distinction, right? In California, they will say triple, triple, double, double. That means from the year that you get your first million in revenue, right? You want to triple your revenue again, double and double again. Which means that you do get to a $1 billion valuation based on 100 million in revenue within the 4 years, right? And in some ways, right, different markets and different industries can support that kind of growth rate. So, but let's hear from a successful founder. No pressure. What are your thoughts around?
So Lovable and Devin, they're more like the outliers. So they are the ones which makes the headlines and inspire the next generation of founders that I can build the next Lovable and the Devin. But they are not usually the norm. It's just more hard work. It takes longer, etc. And the usual matrices is what probably is still relevant, which is the ARR growth, your NRR, what is your CAC payback period, etc., etc. And talking about the valuation that the companies that are getting in the Silicon Valley, I think the founders use it as sort of like a bargaining matrix when they're trying to negotiating with the investors over here. A company in a similar domain has raised us like 50x, give me at least 20x or stuff like that. But the market dynamics is very different here, so it doesn't really work out. Just because you're building a similar company here, you can come at a similar valuation.
How many people here follow Peter Walker from Carta, who's constantly publishing like valuation deals and investments, right? I met him in California. He's probably has an outsized influence on founder expectations. And I think we should hint to our VCs here that they should become equally prolific in publishing benchmarks.
I'll tell you this. I think that there is a pressure. I have a lot of friends in the Valley, right? We're part of the Kaufman Fellowship. So it's the Kaufman Fellowship is a global PTSD Alcoholics Anonymous for venture capitalists. And venture capitalists in the Silicon Valley are being pressured to make checks like that. And as a result, they turn around and they go like, I'm only going to invest your crazy valuation if you do triple, double, backflip, pirouette. Yeah, and last time we saw that was in crypto. Last time we saw that was in something else, and then of course in 2001 it was Indonesia as well and Singapore. So I think I'm being very practical about it. If you think you've got a shot at being like an AI-focused Y Combinator, shiny startup to get that high valuation, that's the game you play. You do it. But there is capital that's very thoughtful around the world, including in Singapore, and they're available. And I just want to say, we're happy to also have a look. Just that it will be hard to underwrite something.
Yeah.
Although the Chinese founders give us a different valuation, and we're seriously thinking about it. So it's not easy either way to think about it from a valuation perspective. Just be honest. Yeah, sorry. Just be honest. A lot of people come in with fake metrics. And that really turns off because it creates the question in the person that you're trying to have a 10-year relationship with, i.e. your investor, about whether this guy's going to be disingenuous. So I've seen people come in and say, I've got 2 million users, and then 50% of them are in Puerto Rico, right? And they're like, we're going to find out this kind of stuff. It's just going to be, if I like you and I want to get you past the investment committee, that's already a red flag. So be sincere about your traction. Try not to game your metrics, right? And fair enough. Because you're trying to build a long-term relationship with somebody and you're going to get found out.
I just want to point out at this point we have standing room only, so you guys are really dropping some truth nuggets. But Murli, you're jumping in with.
No, I was going to say, you mentioned Peter Walker,
yeah,
right?
Yeah.
And I saw a post he did just the other day where he was doing a simulated portfolio with essentially simulating what a result of a various strategy could be, concentrated versus diversified, etc. Doesn't matter. At the very bottom, he says, my assumptions going into this were, he says, 70% of the portfolio we assume goes to zero. 70%, right? And maybe, I think he said something like 7% has a $100 million exit, a $200 million exit, something like this, okay? Exit.
That's a bit optimistic in your mind. Is that what you're building up to?
No. I'm saying that if you're playing the game of the very high, high valuation, high risk, but potentially high return, these are the numbers that you're facing, right? Which is why we like the boring but important. Which is why our failure rate is not 70%. Our failure rate is, remove one digit from that.
So I saw Thomas Tunguz, who now is repping Thesis Ventures, and he says the typical VC will look at 100, 200 founders and then maybe do one deal. He's at the point of 500 to 1,000 before he does one deal because he's looking for real category creators and he's saving capital for multiple follow-on rounds because he's not in it for dilution whatsoever. So that's a very different mindset from what I have here in Singapore. I'm a sixth generation Singaporean, guys. I'm not a Ang Mo coming here to talk about something completely out of context. But I think it's interesting here, right? When we start to say, Hian, you've mentioned financial prudence, and I'm sure this is important. Let's not talk about fudging metrics. I don't want to go into that rabbit hole. But in terms of prudence, do we even think of the rule of 40, which I first heard from the VC David at Balderton Capital, right? And this rule of 40 is about, let me just read it out to you so I don't get it wrong. It's your growth rate in percentage plus your free cash flow margin in percentage, right? Has to be more than 40. So this is their way of assessing is your growth rate and your profitability in sync, as opposed to the Uber stereotype where we're burning $100 million, we're not going to see profitability even at IPO.
That qualifies as rule of 40, like you have 200 growth but minus 50 in margin.
So you both fall below zero, right? But they're looking for that optimal balance. Can you get to like 5%, 10% margins?
What's the question?
Right. So in terms of financial prudence, we've been talking about that big idea. They come in with their 3-slide deck, right? And on your third, fourth, fifth conversation, it gets real.
Yeah. By the way, how are you doing? I just want to entertain. Okay, good. And then it's like people standing out there. Come on in, man. Come on. We don't bite. I've got 14 more minutes.
And if you're fundraising, come and swarm the VCs
come on over
and
here. We'll hang
send
out
your
and,
pitches to their websites.
So this harks down to the question as to the way, thank you so much for sitting down, the way in which you pitch a venture capitalist. And you really got to know your audience. Some people just like to shoot for the moon. In fact, some people like to meet entrepreneurs which are arrogant and, persuasive and borderline narcissistic, right? And others don't like that, and you become as a nice guy. So first of all, read the room. But be authentic to the thing you want to do. If you're going to do a business like a foundational model business, there's an argument that you don't charge anybody any money, you put it out in the wild. If it turns out to be great, grow like hell, and promise people that somehow you'll find some monetization. 9 of the venture capitalists will say you're completely mad. 1 will say, I love it. Holy shit, where have you been? Like, you only need 1, right? So stick to your authenticity. Then there's other people who go like, you know what, like I'm a SaaS company, I'm growing at like 23% and I have a 20% margin. So I have a 43 rule of 40. And then the charts are very nice. You go in, you wear suits, and you look quite. And then Shane, my business partner, loves those things. And I just like fall asleep, I walk out, right? So it really is a function of the way that I don't think there's a right way of doing things. And nowadays, in AI, I think that there are really 2 things that are happening. Those people are trying to make the Kraken, like the foundational model that destroys everybody. Oh my God! And those, like I've seen a lot of Chinese teams come out here and say, "Oh, we're gonna just like crush Sora. We're going to be better than Sora. Are you in, Hian? What kind of weak VC are you?" And I'm like, I'm sweating, right? Because he's really good, right? And then I got other people go like, I'm just going to make an agentic thing and I'm going to go squeeze it. And then that's my problem. So then what happens is, you know what I feel like? Just really be sincere. Just like, I'm doing that. Like, you want to come along or not? Like, And I bet you if you meet 30 investors, one or two will come along. I met 32 investors before I got my first check for Asian Food Channel. And so that's how I think fundraising happens, and that's how I view the world after 2 decades.
I think one other thing, I actually recently heard this expressed very well on a different panel I was on last week by somebody else. I'll relay what he said, which is very good advice. He says figure out not just the dynamics or the personality of the person, but figure out their business model, right? Who are their LPs? What are they looking for, right? So for example, if you go to someone who has a $500 million fund, for example, then your exit needs to be really large, and you can figure out the math yourself. It's not that difficult. Versus someone who's managing 50 versus someone who's managing 5, right? Those are very, very, very different people, right? If you don't know the business model of the person you're going after, guess what? You're misaligned from day one, right? And you don't know the questions they're going to ask you after they invest, if they invest, and you're in for a whole bunch of trouble. It's harder than getting divorced. You know, this is serious stuff.
Any thoughts? Yeah.
Yeah, I think it has evolved over the years. So when we started out back then, we are told burn money as fast as you can, because the next check is just out there. So burn through all the money, grow fast, and go for the next round of funding. Doesn't really matter how much you are burning, 100K, 200K every month, because you will have somebody else funding. But it's good to see some sanity coming in, where it's not like how much you are growing, but how much you are burning to grow. So yeah, so that's where we see like more savvy metrics like the rule of 40 and others coming into play now. But it again really depends at what stage of fundraising you are and what is your maturity. If you're an early stage startup at seed, you probably don't have enough data to back up the numbers that you really have. There is just not enough proof point to say that even if you have a rule of 40, etc., it will work out 2 years from now. So depending on the stage and who are you pitching to, you might have to look into different matrices.
Do you guys have anything else that you want to talk about? Because we have more questions, but we can also open up to the audience for questions.
Maybe there was just one last thing on this.
Why don't we do like a whole bunch of things? People get to prepare to like ask questions.
Yeah.
I see people standing there. Like, look, 9 minutes, sit down. My KPI is by the time we're done, the next bunch of people have a full audience.
My KPI is how many LinkedIn posts are written quoting you guys. Yeah.
What's your last question?
So I was going to say that, completely agree. Rule of 40 may not apply to very early stage companies. So for example, one of the rules or one of the metrics you might want to showcase to your investors, let's say at the Series A stage, would be for every dollar you've raised, how much ARR have you got, right? If you're raising $1 to get 50 cents of ARR, that's not good.
Oh, so what's the ratio? I actually don't know this.
So the ratio has actually gone up over time, right? So we have a company in our portfolio which actually, for every dollar they've raised, they managed to get more than $2 in ARR.
What's the ratio that you get excited?
What gets me excited? Like I said, this one is saying 2 for every 1.
So
that's
2 for
amazing.
1.
That's amazing.
Buy 2 and 1 free.
1 for 1 is actually okay.
Okay.
Right?
Okay, so
when money was cheap, 1 for 1 was considered great. Right? When money was cheap. These guys, at that time, were doing 2 for 1.
Interesting. I got to learn that one. Thanks.
I suppose we plan on burning $200 million in paid advertising in the next 6 months.
So that's the problem, which is like people come in and say, I've got like a huge ARR, and then you're underlying it, and it's just basically a wrapper for something, and you're generating value because, like, this thing is, you don't pay for it, but you're burning more tokens, and then you just ask the question, how are you actually going to make money? That's a problem. So we get excited by like the fact that you have some fast ARR, but we question how much value you're actually generating to it. But then the other challenge, of course, is that token costs drop about like 10x every 18 months, roughly, right? And so there is an argument that you actually just burn now and hope that in like 12 months' time, the tokenomics actually work to your favor. But then you also have the problem is somebody else might drop your price. So it's very dynamic and it's not a given. I like to just ask the way which you pitch it. Because if you come to a VC and you say, I got 100 million ARR revenues, and you don't want to tell your cost structure, and you try and get the money, again, it comes back to that first principle, which is not very good for a 10-year relationship, right? So you have to be authentic about it. If you say, look, listen, right now I'm losing a lot of money, but I believe that, we can make our models smaller, we can drop our inference cost. So in the long run, that's how we're going to be profitable. At least say that as your plan, as opposed to something else, which is disingenuous.
Yeah, I think many founders are not dumb at all, right? Many of them quite intelligent. Sometimes it's the investor that enables sort of bad behavior. So in many cases, the investor's at fault. So when someone simply quotes a $100 million number, in many cases nowadays, I won't name specific companies, people who have become wrappers and LLMs, actually they're not tech companies. They're actually wholesalers of tokens. That's what they are. They're buying cheap and selling for more expensive, and that's not a great business. It's like me buying, bulk pens and selling them for retail price. That's not really a business, right? I mean, where do you see the value from that?
That was ride-hailing giving big subsidies. And I say it because I invested into Gojek, so I call it, right? And everybody was using ride-hailing. But now, it's expensive, but people still use it. So.
Wait. Can I object there? Ride-hailing subsidization was customer acquisition, right? But the value of the taxi ride was the same,
yeah.
right? It's just how much you're paying for it. But tokens now...
No,
right? If I'm a wholesaler of tokens, if I'm a wrapper for a dental chain, right, and I can prevent like misdiagnosis or the wrong thing.
In my books, you're allowed to subsidize to get market adoption. Once you pass that whatever 16.2% that Simon Sinek always says, then we used to go from like, instead of growth hacking to like just growth subsidizing. And then that is when the point of bad behavior happens. But if your competitor is doing that and everyone in the industry is doing that, you have no choice and you burn like heck, and then the investors pay for it. I think it feels like that kind of a dynamic in AI right now. And I just want to say at one point in time it was ride-hailing, at one point in time it was telecom fiber, and that's just how the cycle works.
Ride-hailing was the network effects, right? If you have my app, you're not going to look at two apps at the same time for the average user. So
but I don't agree. You have no choice but to. You can always do something different, right? When everyone zigs, you zag, right? You go do a different business. Your business model might be different. You might go after a different set of customers. If you're in Southeast Asia, maybe you're solving, industrial groups' problems. They don't give a shit about, can I say shit? They don't give a shit about your token wholesaling thing. They're saying, look, can you solve my problem of, workforce productivity or whatever, right?
Like something quite traditional like Harvey, right? In the States, it's law, it's AI for law, and it's transcription, summarization, and digging data. But they are making bank because they have market share.
So maybe just to, the good news is that we're going to the next phase of AI where the application of AI, agentic, the productivity gains means that you don't have to play the high octane game that you read on Bloomberg. And there's going to be a Cambrian moment, and I said this in the Super AI conference, where there are localized models in Southeast Asia, in other countries, where the application of AI creates not that kind of a Godzilla type effect. But you're seeing that in the Valley right now, and the mistake would be to assume that that's the only game to play when it isn't.
So we've got a few minutes left. Does anybody have any burning questions? Thank you. Please introduce yourself and ask a brief single question. Thank you.
Hi, my name is Pradeep, and we are actually trying to reinvent the travel space using AI and personalization. But I got to tell you, this is one of the most fascinating sessions I've sat yesterday and today, just to see how different people's perspectives and opinions and how they look at founders and businesses vary. And as founders, how we alignment is important. But my main question is more than the funding. A lot of times funders are looking for the right VCs to align. So to open up markets, to partner with their other companies that they've invested in, and to start to create better value both for the founders as well as for the VCs. So how do you look at companies that are not just looking for funding, but looking for other ways that VCs can add values, and how do you evaluate such companies?
That's a poorly question.
He's pointing to me to answer that question.
Capital versus smart money. Where do you guys think?
Well,
about
he didn't
that?
say smart. He just said add value, and So what I like to say is, different VCs can add value in different ways. Some will add value by not doing anything, which is good, right? No, I don't mean it as a joke. I mean it very, very sincerely. If there's a VC out there that you prefer to partner with because he'll give you money and then just stay out of your way, and you want that, go for that, right? That's a very, very valid place to be. You might instead want someone who says, look, I know your industry very well, so therefore I'm going to come and help you open doors or whatever it might be. Somebody else might say, like in my case, I have a strong belief that you achieve success by avoiding failure. It sounds weird if I say it that way, but it's actually what Charlie Munger used to say. He says, invert the problem every time. Don't look at the goal. Instead, look at everything that would prevent you from getting to that goal and avoid those things, right? Every additional day you stay alive is an increasing chance of eventual success. I have that strong belief. And I've seen, I don't know, over the past 20 years, 30 different types of mistakes. If I can help you avoid those 30 different kinds of mistakes, the 31st might kill you, but I've given you a good fighting chance, right? My job is not to give you new ideas or advice or whatever, because founders are brimming with ideas already. My job is to help prevent the wrong ideas, right? Very occasionally when a founder really says, no, I really want your opinion on something that, in a positive way, then I'll open my mouth. But by and large, I try to say, look, here's the things let's try to stay away from.
As a founder who knows many founders as well as your personal experience, where do you fall on that spectrum of family officers who can give you a significant check, but you know that they will most likely not be value add to your business model, all the way to a VC who is industry specific and opens up market connections?
So on our cap table, we had all types of VCs over there. I think it really depends on the stage that you are in. At an early stage, go for a VC because they will have the pace, they will bring in the governance, etc. If you're talking to a CVC, they will ask for a lot of matrices which you will not have, and they will take a lot longer time. But when you reach a certain level of maturity in terms of your business and your product, and you have a CVC who is in the same industry, they can really help you in go-to-market and open more doors for you. And family offices, while the decision making can be a lot faster, there may not be a lot of value addition from their end, which is fine if you're just looking for somebody to fill the round, etc. And they also come at a stage where they are a lot more comfortable because they don't know how to evaluate like a VC. But at a later stage, when you have a term sheet and a lead VC, the business has reached a certain maturity, then the family offices make sense. So I would say that it depends on which curve you are in terms of the company. So that's when you bring in the different people to be on your cap table.
And on that bombshell, our time is up for today's session.
Can I just one thing? Who's heard of the Generalist podcast? The Generalist, Michael Smith, right? I hope this aspect sparks a discussion. Go to the Generalist podcast. All of us are going there and putting our point of view. If you haven't seen Michael Smith, go there, talk for an hour. And that's the best resource for you guys to know who is financing people in Southeast Asia and the way they think about it. I just wanted to put it out there so that people can continue the conversation. I just did my session at the Generalist podcast.
Fantastic. We'll look out for that. So we'd like to thank you. I think we have to thank Hien, Murli, and Som for some very candid, and I hope that this candid conversation is helpful for all of you. Thank you all very much. And we have a word from our sponsors. I think we just need to put something up. So this is all in anticipation of the program that Minister Gan mentioned yesterday and was signed by Enterprise Singapore and NUS Enterprise. It's the AI Accelerate track. If you're looking for funding and if you're looking for go-to-market with Microsoft and NUS Enterprise, this is the program that I'm a part of, my company AI Path. Please apply here. You can also chat with us to understand the program in detail, but we hope that we can support your growth in Singapore. Thank you again to all our panelists. They've been amazing. You've been amazing. Thank you very much.
Thank you so much, our amazing panelists. Let's grab a group photo together before we leave the stage. That was such a fantastic discussion, and I hope that all of you enjoyed that as much as I did. So once again, a big thank you to NUS, Microsoft, and our panelists for that essential roadmap to navigating the AI investment landscape in 2025. So the era of selective optimism is officially here, and we're so happy to have you guys join us. And now we're gonna shift from money to the product in just about 6 minutes from now. We're going to dive into how AI is moving from general purpose to deep specialization with the next session titled Vertical AI in Action, Video Intelligence, Finance AI, and Memory-Centric Systems. So the next session will be powered by NTU and will feature founder-led demos showcasing scalable and secure intelligence tailored for specific domains. All right, so don't go anywhere. We're going to get started with the next session in just about 5 minutes from now.